Well, joining me with more on this economy and what we can expect from the Fed is Ed Yardeni. He's a president of Yardeni Research. Ed, it's great to have you on the show this morning. And with that retail sales data just moments ago, plus a Fed decision on tap, what do you think it means for investors?
Well, I think it confirms that the economy has been remarkably resilient over the past 3 years or so. We've experienced the most widely anticipated recession of all times that never happened. And the economy just continues to crank out solid numbers despite the fact that the Fed did tighten. But now the Fed is easing. And so the prospect is that the economy, led by the consumer, will continue to grow. For investors, that's obviously a positive for earnings and a positive for the market.
What do you think it means for the Fed decision tomorrow, Ed?
Yeah. Well, I think the Fed has pretty much signaled that they're going to do 25 basis points. They could still surprise us. I mean, they've provided enough guidance out there that they want to pause, that they might pause on Wednesday. But right now, it looks as though they're going to do 25 basis points. I think it's widely anticipated, and I expect it'll be a hawkish cut, which means, it'll be kind of like thanks, but no thanks. They'll give us a rate cut, but they'll make it very clear. Jerome Powell in his press conference will make it very clear that the economy is doing better than they thought. Inflation's a little bit stickier, so maybe they're going to pause for a while.
And in terms of what the consumer is telling us, we know consumer spending does make up the bulk of the economy, Ed. The consumer seems to be in a pretty good shape. Is that right?
Very good. Yeah, absolutely. Look, the employment numbers can be volatile from month to month. They certainly, on balance, indicate that jobs are still being created. There's still plenty of job openings. Wages are actually increasing faster than prices. And then we've got a lot of people like me, baby boomers, that are retiring. I'm still working for a living, but the baby boomers are sitting on something like over $70 trillion of net worth. And as they retire, they are going to be spending those nest eggs. So all in all, the consumer's doing fine. Not everybody's doing fine. There's low-income consumers where we're seeing delinquencies going up, but delinquencies never cause recessions. They make recessions worse. And at this point, I think we've got to unbalance a consumer that's going to keep the economy growing.
I'm curious, Ed, in terms of a new administration set to take the Oval Office in January and strong growth that we see in the data, how that sets things up, especially for the Fed in 2025, and what it might mean for Fed Chair Jerome Powell.
Well, some of us are kind of confused by why the Fed has been signaling that they intend to lower interest rates fairly consistently going into next year. We'll see what the state comes out tomorrow says in terms of what they expect to do next year. But there's a lot of uncertainty about fiscal policy, and fiscal policy has been very stimulative during the Biden administration, and it looks like the stimulus is going to continue with tax cuts under the Trump administration. So I think fiscal stimulus is one of the reasons the economy continues to grow, and the Fed really has to factor that into their modeling of what they should be doing next. They don't want to combine very stimulative fiscal policy with very stimulative monetary policy, because then all the progress they've made on bringing inflation down will be for naught. And suddenly they'll be faced with an inflation problem again.
Does that have an outsized impact to the upside for certain sectors?
Well, look, I've been keeping it fairly straightforward, recommending overweighting mostly cyclicals. I think that continues to be the right place, though they're not cheap anymore. But technology, communication services, I think, continue to work. Those largely include the Magnificent Seven. So does the consumer discretionary. It includes Tesla, for example, and Amazon. So I think the sectors, the consumer discretionary and technology and communication sectors will work, and I think they will continue to be led by the Magnificent Seven, like financials a lot and industrials a lot still. I think the other sectors, I'd be underweight.
Interesting. One of the stories that we're covering later in today's show, Ed, is, of course, this massive investment that SoftBank's Masayoshi Son is expected to make in the U.S. following President Trump's election. Taking of the Oval Office, we should say, of the president-elect. What does that mean for jobs in America?
Well, I think clearly there's a more pro-business attitude coming in with the new administration. And that's already been reflected in the fact that technology CEOs, as well as venture capitalists, are flocking down to Palm Beach to have with President-elect. So I think it's all good. Technology, however, is not a huge employer. It creates a tremendous value without a great deal of upside in employment. But look, the labor market's very tight. I don't think we want to try to create too many more jobs because I'm not sure we got the workers to fill those jobs. But certainly, if we get our immigration situation fixed so that we can bring in a lot more qualified people legally, that would be very helpful for the U.S. economy.
Ed Yardeni, thank you so much for joining. Of course, an action-packed 2 days here as we await that Fed decision as the
Indeed.
president of Yardeni Research.